Ladies and gentlemen, pioneers, visionaries, and believers in the future of decentralized finance, welcome to my YouTube channel, Divination-DD Here. We dive deep into the mysteries of divination, but today, we focus on something just as powerful: the Pi Network and its journey toward global adoption. The Pi Network has been a revolutionary project, promising to reshape the financial landscape with its decentralized, peer-to-peer payment system. Many of us have dedicated years to mining Pi, believing in its potential to become a truly borderless currency. But as we move toward the so-called open mainnet, there are critical issues that cannot be ignored. Pi Network has not been granted integration with QFS, Quantum Financial System, or SWIFT, two major financial infrastructures that determine a currency's ability to function. Why Pi Network was not granted QFS and SWIFT integration, has no DEX, and how it can open network trading. Introduction. Pi Network has positioned itself as a revolutionary blockchain project aiming to create a decentralized, mobile-friendly cryptocurrency that can function as a global payment system. With over 70 million engaged users, its ambition is to become a widely accepted digital currency for real-world transactions. However, despite its strong community and technological advancements, Pi Network has faced several challenges regarding its integration into the global financial system. This article will explore three critical aspects of Pi Network's development: why Pi Network was not granted Quantum Financial System QFS and SWIFT integration by U.S. authorities, why Pi Network has not launched its own decentralized exchange, DEX, how Pi Network can open network trading in the future. By understanding these key issues, we can better assess the project's current position and the steps it must take to achieve mainstream adoption. 2. Understanding QFS and SWIFT integration. 2.1. What is the Quantum Financial System, QFS? The Quantum Financial, no direct institutional partnerships. Unlike projects like Ripple, XRP, which has secured partnerships with banks, Pi Network has not yet announced significant financial collaborations that would make it eligible for SWIFT integration. Concerns about decentralization regulatory. Authorities are cautious about cryptocurrencies that claim decentralization, but lack clear governance structures. Pi Network's unique model, where mining is mobile-based and transactions are currently limited, raises questions about how it will ensure compliance with financial regulations. Thus, while QFS and SWIFT integration could be potential long-term goals for Pi Network, the project must first achieve a stable, open network and regulatory compliance. 3. The absence of a Pi Network DEX. 3.1. What is a decentralized exchange, DEX? A decentralized exchange, DEX, is a blockchain-based platform that allows users to trade cryptocurrencies directly without relying on a centralized authority. Popular DEX like Uniswap and PancakeSwap operate on smart contracts, enabling peer-to-peer P2P transactions without intermediaries. 3.2. Why hasn't Pi Network created a DEX? Despite having a large user base, Pi Network has not yet launched its own decentralized exchange. 4.2 Steps for opening Pi Network trading. For Pi Network to enable open trading, it must complete KYC for the majority of users. A verified user base ensures that Pi transactions are secure and compliant with regulations. Launch an official Pi wallet with exchange features. A native Pi wallet with built-in trading functionalities would allow for seamless P2P transactions. Develop partnerships with payment processors. Collaborations with platforms like Visa, MasterCard, or blockchain-friendly banks would facilitate real-world transactions. Introduce a staged liquidity release strategy. Instead of allowing all Pi to enter the market at once, a gradual release plan would help stabilize its value. Ensure compliance with global regulations. Meeting AML and CTF standards is crucial for Pi to gain legitimacy in international markets. 4.3 The role of P2P transactions in Pi's future. Pi Network is designed to function as a medium of exchange rather than a speculative asset. P2P transactions between merchants and users will play a key role in its adoption. Instead of relying on centralized, meanwhile, he saw many scammers and bot accounts getting verified quickly, which raised concerns about Pi's security measures, shifting deadlines and lack of transparency. When James first joined, he was told that Mainnet would launch in 2020. This later changed to an enclosed mainnet. With limited functionality, Pi's open mainnet was initially expected in late 2024, but was postponed to Q1 2025 without clear reason. The lack of clear timelines made him feel that the core team was intentionally keeping things vague. Outcome: frustrated with the delays and lack of communication, James stopped running his Pi node. He lost trust in the core team and no longer promotes Pi network to others. Many of the users he invited became inactive after experiencing similar delays and unclear policies. This case highlights how poor communication, slow KYC verification, and missed deadlines are driving away some of Pi's most dedicated early adopters. Example 2. A merchant who accepted Pi but faced liquidity issues. Background: Sophia, a small business owner in Nigeria. Example 2. The absence of a Pi. Network DEX. A comparison with Binance, Smart Chain, BSC, and Uniswap. This case study will cover what is a DEX and why is it important for a crypto ecosystem, how Binance, Smart Chain, BSC, and Uniswap successfully launched their DEX, why Pi Network has not yet created a DEX, the risks and benefits of Pi launching a DEX, lessons Pi Network can learn from Binance and Uniswap. I'll provide the full write-up shortly. Example 2. The absence of a Pi. Network DEX. A comparison with Binance, Smart Chain, BSC, and Uniswap. Introduction. A decentralized exchange, DEX, is a crucial part of any blockchain ecosystem, allowing users to trade cryptocurrencies without intermediaries. Many successful blockchain networks, such as Binance Smart Chain, BSC, and Uniswap, Ethereum, have established thriving DEX platforms, boosting adoption and liquidity. However, Pi Network has not yet created a DEX for its ecosystem, leaving many wondering why. Is this a strategic decision, or is Pi Network missing a key opportunity? In this case study, we will explore the role of DEX in blockchain ecosystems, how Binance, Smart Chain, and Uniswap successfully launched their DEX, why Pi Network has not yet created a DEX, the risks and benefits of launching a Pi DEX, lessons Pi can learn from Binance and Uniswap. 2. What is a DEX and why is it important? A decentralized exchange, DX, allows users to trade cryptocurrencies directly with one another, using smart contracts rather than relying on a centralized authority. 2.1. Key benefits of a DEX. No middlemen. Users maintain full control of their assets without trusting a third party. Security and privacy. DEX are less vulnerable to hacking, since funds are not stored in a centralized database. Censorship resistance. Governments or financial institutions cannot shut them down. Liquidity for crypto. Unlike traditional exchanges, Uniswap uses an automated market maker, AMM model, where users trade against liquidity pools rather than order books. Impact of Uniswap on Ethereum. Allowed thousands of tokens to launch without requiring centralized listing. Increased Ethereum's transaction volume, making it a global hub for decentralized finance, DeFi. Encouraged other blockchains to develop their own DEXs, such as PancakeSwap on BSC. Both BSC and Ethereum benefited significantly from their DEX. So why hasn't Pi Network created one yet? 4. Why Pi Network has not yet created a DEX. There are several possible reasons why Pi Network has not introduced a decentralized exchange. 4.1. Pi Network is still in the enclosed mainnet. Unlike Binance and Ethereum, Pi Network has not yet fully opened to external blockchain networks. A DEX requires open liquidity, but Pi's transactions are currently limited to its own ecosystem. 4.2. Regulatory concerns. Many governments closely regulate cryptocurrency exchanges. Pi Network may be avoiding regulatory issues before launching trading options. 4.3. Stability before trading. If a Pi DEX launched too soon, the price could become highly volatile. Pi's team may be waiting to establish a more stable ecosystem before introducing a DEX. 4.4. Focus on real-world transactions first. Unlike BSC and Ethereum, Pi Network aims to be a currency for everyday transactions rather than just a speculative asset. A DEX might not align with Pi's long-term vision of being a stable, widely used currency. 4.5. Preventing market manipulation. Binance and Ethereum DEXs have been targeted by whales and market manipulators. Pi's team may be designing protections against price manipulation before launching a DEX. While these are valid concerns, the absence of a DEX means Pi lacks a key feature that has helped other blockchain ecosystems grow. 5. The risks and benefits of Pi Network. Launching a DEX. If Pi Network were to introduce a decentralized exchange, what would be the pros and cons? 5.1 Benefits of a Pi DEX. Despite its cautious approach, Pi Network can learn valuable lessons from Binance, Smart Chain, and Uniswap to successfully launch a DEX when the time is right. 6.1 Introduce liquidity pools for stability. Binance and Uniswap used liquidity pools to stabilize trading. Pi Network could implement a community-driven liquidity system to prevent price manipulation. 6.2 Focus on user-friendly design. PancakeSwap and Uniswap succeeded because they were easy to use. Pi Network should ensure that its DEX is accessible to everyday users, not just crypto traders. 6.3 Regulate the launch carefully. Binance controlled the launch of PancakeSwap to prevent scams. Pi Network should introduce gradual trading limits to maintain price stability. 6.4 Integrate with real-world use cases. Instead of just creating a trading market, Pi could design a DEX that integrates directly with businesses and merchants. A hybrid model combining P2P, payments, and decentralized trading could give Pi an edge over other DEX. 7. Conclusion. While Binance Smart Chain and Uniswap benefited greatly from launching their own DEX, Pi Network has taken a different approach, focusing on real-world adoption before opening trading. Pi Network has not yet created a DEX because it is still in the enclosed mainnet phase. There are regulatory concerns. The team wants to ensure stability before trading begins. Pi aims to be a currency for everyday use, not just a speculative asset. However, Pi Network can still benefit from a decentralized exchange in the future, and by learning from Binance Smart Chain and Uniswap, it can avoid common pitfalls. The question remains, will Pi Network introduce a DEX in the future, or will it continue to focus solely on P2P transactions? Example 3. The Terra, Luna collapse. Lessons for Pi Network before opening trading. This case study will cover overview of Terra, Luna, and its UST. 2. Overview of Terra, Luna, and UST. 4.1 What was Terra, Luna? Terra, Luna was a blockchain network created to support algorithmic stablecoins. The most famous of these stablecoins was UST Terra USD, which was supposed to maintain a 1-1 peg with the US dollar. 2.2 How did UST work? Unlike traditional stablecoins like USDT, Tether, or USDC Circle, which are backed by real reserves, UST was not backed by any fiat currency or assets. Instead, it used an algorithmic mechanism with Luna. To mint 1 UST, users had to burn $1 worth of Luna. If UST lost its $1 peg, people could burn UST to get Luna, stabilizing the price. This system worked as long as demand remained high, but had major weaknesses. 2.3 Why did people invest in Terra? The biggest reason Terra became popular was Anchor Protocol, a lending platform that promised a 20% annual yield on UST deposits. This unsustainable high interest rate attracted massive investments. Institutions and retail investors rushed in, thinking UST was a safe stablecoin. But in reality, Terra's entire system was a ticking time bomb. How Terra, Luna, achieved massive growth before its collapse. By early 2022, Terra had built an ecosystem that looked strong on the surface. Millions of users were earning 20% APY, annual percentage yield, through Anchor Protocol. Big investors, including hedge funds, put billions into Terra. Luna's price skyrocketed, reaching an all-time high of $119 in April 2022. UST's market cap grew to $18 billion, making it the third largest stablecoin. Pi should focus on real-world adoption, not just price speculation. The goal should be stable transactions, not a pump-and-dump cycle. 5.2 Do not depend on an algorithmic model. Terra's algorithmic stablecoin model failed catastrophically. Pi should ensure that its economic model is backed by sustainable value. Any exchange mechanism for Pi should be transparent and easy to understand. 5.3 Ensure liquidity before opening trading. Terra collapsed because there was not enough liquidity to support UST. Before Pi opens trading, it should ensure there is enough demand and real use cases. Gradual trading limits could prevent a sudden market crash. 5.4 Build regulatory compliance from the start. Terra's failure led to government crackdowns and legal issues. Pi Network must work within legal frameworks to ensure its stability. It should avoid launching a system that regulators might later shut down or restrict. 5.5. Avoid an unsustainable reward model. Terra's 20% yield created artificial demand, leading to a bubble. Pi Network should avoid unsustainable rewards or unrealistic promises. A gradual economic model will ensure long-term stability. 6. Strategic steps Pi should take before opening trading. To prevent a Terra-like collapse, Pi Network should follow a careful and structured approach before allowing open trading. 6.1. Step 1. Controlled trading in phases. Start with limited P2P transactions instead of full market exposure. Implement gradual withdrawal limits to prevent a market dump. 6.2. Step 2. Real utility before market speculation. Encourage businesses to accept Pi for goods and services. Increase real-world adoption before allowing speculative trading. 6.3. Step 3. Avoid algorithmic models for price stability. Pi should avoid Example 4. China's crypto trading ban. Lessons for Pi Network before opening trading. This case study will cover China's history with cryptocurrencies and trading bans, the impact of the ban on Bitcoin, Ethereum, and other cryptos, how the global market reacted to China's ban, what Pi Network can learn from China's regulatory approach. Strategic steps Pi should take to avoid regulatory risks. I'll provide the full write-up shortly. Example 4. China's crypto trading ban. Lessons for Pi Network before opening trading. Introduction. China has a long and complex history with cryptocurrencies, going from early adoption to a complete ban on crypto trading and mining. The Chinese government initially encouraged blockchain development but later cracked down on Bitcoin, Ethereum, and other digital assets due to concerns over financial stability, capital outflow, and fraud risks. This case study will examine China's history with cryptocurrency regulations, the impact of the crypto ban on Bitcoin, Ethereum, and exchanges, how the global market reacted to China's decision, what Pi Network can learn to avoid regulatory risks, steps Pi should take before launching open network trading. By analyzing China's crypto ban, Pi Network can proactively design a strategy that avoids government crackdowns and ensures long-term adoption. 2. China's history with cryptocurrencies and trading bans. China was one of the earliest adopters of cryptocurrencies, with Chinese exchanges like OKCoin, Huobi, and Binance dominating global Bitcoin trading in the early 2010s. However, the government gradually tightened restrictions due to concerns over financial risks. 2.1 Key events in China's crypto crackdown. 2013. First warning against Bitcoin. The People's Bank of China, PBOC, banned financial institutions from handling Bitcoin transactions. This was the first sign that China viewed crypto as a financial risk. 2017 ICO, introducing the digital yuan. China launched its central bank digital currency, CBDC, which it wanted to promote instead of decentralized cryptos. This strict regulation forced crypto businesses to relocate and impacted global markets. 3. The impact of the ban on Bitcoin, Ethereum, and other cryptos. China's decision to ban crypto had major consequences for the industry, especially because Chinese miners controlled over 65% of Bitcoin's global mining power before the ban. 3.1 Bitcoin's price dropped sharply. When China announced the full ban in 2021, Bitcoin's price dropped by 30% in days. Investors panicked, thinking the market would collapse. However, Bitcoin recovered as mining operations relocated to countries like the US and Kazakhstan. 3.2 Mining industry moved overseas. Before the ban, China was the global leader in Bitcoin mining. After the ban, mining companies moved to the US, Russia, and Canada. This shift changed the geography of crypto mining but didn't kill Bitcoin. 3.3 Crypto exchanges and businesses left China. Binance, OKEx, and Huobi moved operations offshore. Many Chinese crypto traders continued trading via decentralized exchanges, DEXs. Despite the ban, China remained a major player in underground crypto trading. 3.4 China's ban didn't destroy crypto. Despite initial panic, the global market adapted. Other countries stepped in to fill the gap left by China. The ban did not stop Bitcoin or Ethereum from growing, it simply pushed activity elsewhere. This shows that even major government bans cannot fully stop crypto adoption. However, such actions create uncertainty, instability, and loss of market confidence. 4. How the global market reacted to China's ban. China's crypto crackdown caused short-term fear but ultimately 5.1. Avoid direct conflict with regulators. China's ban shows that governments can shut down crypto activities if they see financial risks. Pi should work with regulators instead of resisting them. 5.2. Ensure Pi coin has legal clarity before trading starts. Before launching open trading, Pi network must clarify its regulatory status in major countries. Avoid being classified as an unregistered security or illegal digital currency. 5.3. Prevent over-reliance on one market. China's crypto ban hurt businesses that depended only on China. Pi network should ensure it has a global user base to avoid dependence on one country. 5.4. Be ready for exchange restrictions. Many countries restrict crypto trading or enforce strict KYC rules. Pi network should plan for regional exchange limitations and offer compliant alternatives. 5.5. Focus on real-world adoption, not just trading. Pi network should emphasize P2P, transactions and business adoption over speculation. The goal should be to build an economy, not just a trading asset. By learning from China's crypto ban, Pi can navigate regulatory challenges and ensure a smoother transition to open network trading. 6 strategic steps Pi should take to avoid regulatory risks. To avoid government restrictions, Pi network should work with regulators instead of resisting them. Ensure compliance in major financial markets before trading begins. Prevent over-reliance on one country or region for adoption. Build real-world use cases to reduce speculation risks. Prepare alternative trading methods, P2P DeFi, if exchanges are restricted. By following these steps, Pi can avoid sudden government crackdowns and establish a stable trading ecosystem. China's crypto ban shook the market but didn't destroy the industry. Instead, it forced mining and exchanges to relocate, shifted power from China to other countries, accelerated discussion, and financial regulators rejected it. How Libra tried to adapt but still failed. Lessons: Pi network can learn to avoid a similar fate. Steps Pi should take before launching open network trading. By analyzing Libra's failure, Pi network can design a more resilient strategy for regulatory approval, adoption, and financial stability. 2. Facebook's vision for Libra and why it was revolutionary. Facebook's Libra aimed to be a global digital currency backed by a basket of real-world assets, fiat currencies, bonds, and stable investments. Unlike Bitcoin or Ethereum, Libra was designed for stable value, avoiding price volatility, frictionless transactions across borders, financial inclusion for billions without bank access, instant global payments without traditional banking fees. 2.1. The Libra Association. Facebook created the Libra Association, a consortium of 27 founding members, including Visa, MasterCard, PayPal, eBay, Stripe, later dropped out, Uber, Spotify, Coinbase, investment firms, and blockchain companies. This was meant to decentralize control so Facebook wouldn't own Libra directly. However, regulators still saw it as a Facebook-controlled digital currency. 2.2. Facebook's massive global influence. With over 2.5 billion users, Facebook had the power to make Libra an instant global currency. This scared regulators as it could threaten central banks, weaken national currencies, and disrupt financial systems. The project seemed unstoppable until governments pushed back aggressively. 3. Regulatory pushback. Why governments rejected Libra. The biggest reason for Libra's failure was government resistance. Regulators feared it could. 3.1. Undermine national currencies. Governments worried that Libra could replace local. Despite global opposition, Facebook tried to revise Libra to satisfy regulators. However, these changes weakened its original vision and led to its downfall. 4.1. Renaming to Diem and cutting global ambitions. In 2020, Facebook renamed Libra to Diem to distance it from earlier controversies. Instead of a global digital currency, it scaled back to a US dollar-backed stablecoin. 4.2. Stricter regulatory compliance. Facebook introduced stricter KYC and AML measures. It partnered with banks and regulators to ease concerns. 4.3. Key members left the project. Visa, MasterCard, PayPal, Stripe, and eBay all withdrew from Libra due to government pressure. Without these partners, Libra lost its ability to function as a global payment system. 4.4 U.S. government blocked it completely. Regulators still refuse to approve diem, despite Facebook's changes. The U.S. government saw any Facebook-backed currency as a risk. 4.5 Libra, diem, was shut down in 2022. With no path forward, Facebook sold Diem's assets to Silvergate Bank for $200 million. The project was officially dead, marking one of the biggest failures in crypto history. 5. What Pi Network can learn from Libra's mistakes. Libra's failure shows that even powerful companies can fail if they don't manage regulatory risks properly. Pi Network must learn from these mistakes to avoid a similar fate. 5.1. Work with regulators from the start. Instead of launching first and asking for approval later, like Libra, Pi should proactively engage regulators. Clear compliance with AML, KYC, and tax laws will make adoption easier. Facebook's Libra was one of the most ambitious digital currency projects, but regulatory pushback, lack of trust, and financial concerns killed it. The key lessons for Pi Network are: regulators can block any project that threatens financial stability. A strong ecosystem must be built before launching open trading. Trust, decentralization, and legal clarity are essential for survival. Pi Network has the potential to succeed where Libra failed, but only if it learns from these mistakes and takes a careful, strategic approach to open network trading. As we've explored today, the future of Pi Network hinges on its ability to navigate the challenges that have caused many crypto projects to fail. Avoiding the mistakes of failed ventures, like Facebook's Libra, learning from exchange failures and understanding the risks of open network trading are critical to ensuring Pi Network's success as a truly decentralized, peer-to-peer global payment system. Pi Network has the potential to revolutionize the financial world, but it must prioritize security, community-driven governance, and real-world adoption to sustain long-term success. The road ahead is not easy, but nothing truly revolutionary ever is. If Pi Network stays true to its vision and avoids these 5 key traps, it can dominate the global payments sector and become a true financial powerhouse. For those of you who believe in Pi Network, your role is essential. The strength of any decentralized project lies in its community. Your engagement, your trust, and your active participation will shape Pi's future. Whether it's through transactions, development, education, or simply spreading awareness, every contribution matters. To all the pioneers out there, thank you for your support. Your belief in this project fuels its growth, the journey to financial freedom. And in the 5 key traps Pi Network must avoid. 1. The trap of speculation over utility. Too many projects focus on price speculation rather than real-world use cases. If Pi Network becomes just another trading token, it will lose its true purpose. Pi must be used for goods, services, and financial transactions, not just for buying and selling on exchanges. 2. The trap of centralized exchange manipulation. When cryptocurrencies rely on traditional exchanges, they become vulnerable. Exchanges can control liquidity, manipulate prices, and hurt real users. This is why Pi Network's strategy of peer-to-peer trading before open exchange listing is a critical move. 3. The trap of regulatory non-compliance. Crypto projects that ignore global regulations often face legal challenges, bans, or shutdowns. Libra Diem failed because it ignored government oversight. Pi Network must work with regulators, ensuring long-term stability while maintaining its decentralized vision. Or the trap of weak security and poor technology. A strong blockchain infrastructure is non-negotiable. Many projects collapsed due to hacks, weak security, or bad smart contract execution. Pi Network must continue improving its protocol, security measures, and network strength to remain resilient. 5. The trap of community neglect. A decentralized project lives or dies by its community. Many cryptos failed because they lost the trust and engagement of their users. Pi Network must always prioritize its pioneers, listening, adapting, and ensuring that those who supported it benefit the most. The future belongs to those who build it. If Pi Network avoids these